Okay, so in a recent video, I talked about buying straddles and strangles right before an earnings announcement. So if you know, companies are required to report their earnings every 3 months out of the year, so 4 times a year. And it's a crapshoot. Nobody knows what's going to happen to the stock after an earnings announcement. It could move up big, it could go down big, it could stay flat. So the video I made was talking about you can buy a straddle or a strangle, which means you buy a call and a put option, so you're covered for both directions. And if the stock moves far enough in either direction, you could profit by covering the cost of the whole trade. So if you buy the straddle for a certain price and the stock really goes higher, by the time you sell that call option for a profit, the profit will overtake the cost of buying both the call and the put. But a lot of times the stock doesn't make the required move and you'll end up having a losing trade when you buy the straddle or strangle. So some people have come to me and asked me, they say, Lee, what if we sold a straddle or a strangle? How does that work? Well, you can certainly do that, but you're opening up yourself to unlimited risk on either side. So if you sell a call and you sell a put, and let's just say the stock rallies really hard, you could be in a world of hurt because you have unlimited upside risk. So in this video, what we're going to talk about today is, yes, selling a straddle or strangle, but we're actually going to do it twice. We're going to sell a call option spread and we're going to sell a put option spread, which is called the Iron Condor. It's a dual credit spread. You're going to sell a call spread and you're going to sell a put spread, and you're going to basically surround the stock. So if the stock doesn't make the move that it's supposed to, you can make money on both the call spread and the put spread. People love selling Iron Condors. They do it all the time. So if you've never heard about what an Iron Condor is, we're going to talk about it in this video. All right, so let's just jump right in. All right, everyone, Lee Lowell here from smartoptionseller.com. So what we're talking about today is the Iron Condor dual credit spread, selling a put spread and a call spread to take advantage of whether the stock can make a move required after an earnings announcement. And you don't have to do this before you would put on the trade before an earnings announcement, but you can do this at any time during the year. All you have to do is use the numbers. Now, what I want to do in this video is I want to show you how to use some of the data, some of the numbers to figure out how far the stock is expected to move. And we find out that information by using the implied volatility of the options contracts. And we're going to pull up the option chain. I'm going to show you how to read those numbers and figure out how far the stock is expected to move. And then what you would do is you can sell the call spread outside of that range, and then you would sell the put spread outside of that range, hoping that the stock stays in the middle. And if you know, when you sell options, they decrease in value, and then you can buy those options back for a profit. That's why and how people like to sell Iron Condors. They basically sell the spreads outside of the stock's expected movement. All right. So let's talk about what I want to do is, and I got my notes here. I want to make sure we're on the same page here. So the video that I did last time, we talked about, buying a straddle or strangle on Apple right before an earnings announcement. So Apple typically has their earnings on a Thursday after the market closes. So what you would do is you would buy that 1-day straddle or strangle that expires the next day. That's how you get the options at their cheapest on a dollar basis, not on a volatility basis, but a dollar basis, because options that have only 1 day left before expiration are really cheap dollar-wise, okay? Cheaper than they're ever before in their whole existence. So people like to buy straddles and strangles, a day before earnings, so they don't have to shell out that much money, but they can still lose if the stock doesn't make the move. So let's talk about the Apple straddle and strangle that we discussed, and we'll pull up the numbers again. So here's a chart of Apple, daily chart. So Apple had their earnings on July 31st, which was right here, and the stock was expected to move, I believe, maybe $9 in either direction. We're going to go back to the option chain and take a look. But what happened was Apple really didn't move very far from where it closed on July 31st. The next day, Friday, August 1st, Apple didn't really move far enough. So whoever bought those straddles or strangles lost money, and the sellers of those straddles and strangles made money, and sellers of Iron Condors as well. So what I want to do is go back to one of the free websites that I talk about all the time, which is marketchameleon.com. You can see up here, marketchameleon.com. And the the thing that I showed, they said this is on their free version. I don't use the paid version, so you can see a lot of the numbers are blurred out. But what you do is when you get, you type in the stock up here, Apple, and along the side here, you click on the earnings drop down, right? I'm doing here, and you click on release dates, and it tells you the release dates of their upcoming earnings announcement. But what they do down here is that they tell you how much the stock is expected to move the day before earnings announcement. So and they give you the last six earnings announcements. So here's what the implied straddle is telling you. Now, implied straddle, that's just telling you what the market makers, the option market makers, are calculating the stock should move after the earnings comes out. And based on the straddle on May 2024, May 2nd, 2024, the stock was expected to move 3.8% from where it closes on that day before earnings. And this is the outcome after, one day after. So it moves 6% higher. That's the plus sign. But these last five, you can see it was expected to move 4%. The stock was expected to move 4%. It only moved 0.7%. It was expected to move 3.7%, and it only dropped, the stock dropped 1.3%. And you can see, even on the most recent, for July 31st, 2025, Apple was expected to move 4.4% after earnings, and the stock went down at the close of the next day, 2.5%. So whoever bought these last five straddles or strangles probably lost money because Apple stock didn't move beyond the range that they needed it to. And anyone who sold those options actually came out as a winner. So let's see what the price was. So 4.4% was how much the stock was supposed to move. If we go back to the chart and we see on July 31st, I'm just getting my date here, July 31st, the stock closed at 207.57, $207.57. So I'm just getting the calculator here. I want to make sure that I get the right numbers. So if we multiply 207.57 times 4.4%, that is an expected movement of $9.13 higher and or lower from the 207.57. So the options market makers were expecting Apple stock to move $9.13 either higher or lower from where it closed on July 31st. And if you bought that straddle or strangles, you would have needed Apple to move above, if it's $9 from 207. So it had to go up to at least $216 or all the way down below $198. That's $9 around where it closed on July 31st. And on August 1st, which was the expiration day, it closed at, right here, the close was 202.37. So the stock only dropped about $5. So if you had bought that straddle or strangle for the next day's expiration, you had 1 day left, the stock didn't move the $9 required. It only moved $5. So if you bought that, you didn't make money. If you sold the straddle strangles or you sold the Iron Condors, you made money. But if you look, if you had gone one more week out in expiration, had given yourself one more week, look where Apple closed all the way up here, $229. So it comes down to, you never know when the stock's going to make that move. Yes, Apple didn't make the move needed the 1 day after after the earnings, but if you'd given yourself just one more week of time, look where Apple, it jumped all the way up to $229. So it rallied $22. So there you go. It's all a crapshoot. But more times than not, what I've found over the years is that the stock doesn't really make the required move, and people that sold the options have made money. But we don't want to sell naked options. We don't want to sell naked calls. We don't want to sell naked puts. We do that in our newsletters, but we do it in a certain way. The better way to do it is to sell dual call spreads or the Iron Condor, because that gives you a limited risk, limited reward opportunity. So let me make sure I'm going over my notes here. And I want to talk to you. What happens is that something that's called IV crush, implied volatility crush. So a day or two before earnings announcement, people are getting geared up. They're either buying calls or buying puts, and all that buying pressure pushes up the implied volatility of the options. And since implied volatility is one of the inputs that gives an option its value, if implied volatility starts creeping up right before earnings, that means those options are going to get more expensive. So if you're not aware of this and you're a buyer of those options, you're buying really expensive, not on a dollar basis, but on implied volatility basis. You're buying really expensive options right before earnings. And then when the earnings are announced, all that inflated volatility comes crushing back down. It's called the IB crush, and the option prices come all the way back down with it. So not only will you lose in two ways if you're an option buyer. If the stock doesn't move at all, you're going to lose that way. And you're also going to lose because the implied volatility gets crushed. So I want to show you how that works as well with another free tool here, optionseducation.org. I talk about it all the time. It's open up a free account, and here's an options calculator. And I've got Google pulled up here. Let's just put in Apple for a minute here. And if you type in the symbol and hit enter, it's going to bring up, well, let's do that again. That didn't do anything. Apple. Okay, you hit enter and come on, one more time. Apple. I got to make sure that I click on this thing. Okay, there it will. So it changes all the numbers. So what happens is that, let's just say, let's go out. All right, so you got 6 days to expiration. This is for the next expiration on August 15th. And let's just say, the earnings are going to come out in a couple days. What happens is this implied volatility starts to creep up. Right now it's at 28.36. Let's say it jumps another 10% here. Look at the numbers here. The option values of 2.65 and 3.69. That's for the call and put with these inputs. So if we raise the volatility by 10%, you're going to see these numbers go up. Okay. And we do that. So now each thing went up about maybe a little bit more than $1 per contract, just because the implied volatility went up. I didn't change the stock price. I didn't change the expiration date. The only thing we did was change the implied volatility number, and that moved the options up. Now, when earnings are announced, then that volatility will get knocked back down again, and these numbers will go down. And then if the stock doesn't move at all, you're not going to make any money on it. Okay. So, and this was with 1 day left. So let's just assume this was 1 day, 2 days left. We'll bump this up to 38. Okay. And you got $2 here and $3.20 there. And then the next day it drops by 10% implied volatility. And you can see how the values go down. So you're going to be part of that IB crush when earnings are known and everyone's realized what's happening. So if you're in the camp and you want to sell limited risk, limited reward type of trades and figure out, try to sell them outside of the zone of where the stock's expected to move, you can make money. So I want to show you an example. We're going to use Google in this case. Let's pull up the chart of Google. Okay, we'll look at Google. And right now, Google's making, highs here, $201. Let's see if that's at an all-time high for Google. Yeah, Google's coming on very close to all-time highs. This was the all-time high back in early February. So it's on the cusp. But anyway, let's just assume, you think that, Google over the next week is not going to really go anywhere, and you want to figure out how to sell dual credit spreads or an Iron Condor and take advantage of the situation. Now, Google doesn't have their earnings coming up, but we're just going to use this as an example of what you can do on a regular basis. People do this all the time. They sell Iron Condors on the indexes and the ETFs that really don't move that much, but at the same time, you're not going to get a lot. So if you're selling Iron Condors on more volatile stocks, you're going to get more money when you sell these things, but you're also at risk for the stocks to make a big move. And we're going to look at Google, and then I'll pull up an option chain of Tesla to see if those options are really crazy as well. So let's pull up. Okay, so we have our Google option chain pulled up here, and let's just say today's got 6 days left. So this is a Saturday. So let's pull back a day to 7 days, 1 week to go. Google closed at $201 and change. This is the aftermarket. So let me just see where it closed. It closed 201.42. So that was the 4 p.m. close Eastern time. So this is a number in the aftermarket. But the option prices are based on the 4 p.m. close Eastern time. So let's just assume you want to try to sell an Iron Condor on Google and it closed at 201.40, let's say. And what you would do is you would look at the money straddle to figure out that percentage of how far the stock is expected to move. That's how you figure it out. So 200 strike is the most nearest at the money strike price that has got the most accurate implied volatility. And that is reflected in the option. So to figure out how much a stock is expected to move, you add up the cost of the puts and you add up the cost of the calls, and that'll tell you how far the stock's expected to move by this expiration date. So the calls are worth roughly $4.70. Pull up the calculator, 470, and we add that to the cost of the puts, which is about $3.10. So we're looking at by August 15th, which is 6 days from now, 7 days from yesterday, Google is expected by the option market makers to move about $7.80 higher or lower from where it is right now. And $7.80, let's just round up to $8. That'll take it down to either $192 or up to $208 by August 15th expiration. So what you can do as an Iron Condor seller, sell a call spread and sell a put spread beyond that range. So if Google's only expected to drop down to $192, you can sell, let's say, a 185 put and buy the 180 put. So you're selling the put spread, you're selling the 185 put, and you're buying the 180 put. So that's a $5 wide spread, $5. 185 minus 180 is $5. And on the upside, you can sell the 215 call and buy the 220 call. So you're selling a call spread, you're selling a put spread. Now in this case, you can make about 30 cents here for that spread. I'd say maybe 28, maybe 29 cents as the call spread. And when you sell the put spread, you can get about 15, 16 cents. Okay, so let's add that up. If you get 15 cents plus 19 cents, you're looking at a credit of 34 cents roughly, okay? And let's just make sure we got that 15, 16, and then 55, 30, 29. So 29 and 16, I'm sorry, 29 plus 16 is 45. Got to get the math right. $45. So if you sell that Iron Condor, you're going to get $45, and your maximum risk is $500. You got to take the width of the spread, which is $5. So the maximum you could lose is $500 on the upside or the downside, but you subtract out the $45 that you're getting up front. So your maximum risk is actually $4.55 or $455. I want to make sure everyone understands that. When you sell the Iron Condor, you'll get $45. Subtract that from the $5 wide spread. So that means you're at risk for $455. 455 plus 45 equals 5. I want to make sure everyone understands that. So what you can do is, let me bring up the other website that I have here, which is another free website, optioncreator.com. So what I've done here is I put in and I want to show this to you visually. The current stock price is 201.40, and here's the dual credit spread Iron Condor. Okay, we're going to sell the 215 call, we're going to buy the 220 call, we're going to buy the 180 put, and we're going to sell the 185 put. And here are the prices, okay? And the total debit or credit here in this case is 43 cents. Okay, that's just how I inputted it here. So you get 43 cents and your maximum risk is $4.57. It all has to equal up to 5 since the spreads are $5 wide. And this is what your typical Iron Condor P&L graph looks like. And you can see the really wide range that you can win. As long as Google stays between 185 on the downside down here and 215 on the upside, as long as it stays within that basically 30-point range, you will make some form of money. Okay. Now this is what the spread is telling you. The orange line here, the real sharp line, is what what it looks like at expiration. That's the one we really want to. That's one we care about. And so let's just. This should be 6 days from now. Okay, so there, 6 days from now, this is what it's going to look like on expiration. Right in the middle is basically the current price of the stock. We're at 201.40, and up here, the maximum you can make is the 43 cents per spread, or 43 actual dollars. So here's your profit. You can't make any more than that, but you can make that profit in a wide range of Google over the next 6 days or 7 days, let's just say. And where the chart starts to break right here, those are the strike prices, your short strike prices of the spread. You're short the 215 calls, and that's where it starts to turn, and you're short the 185 puts, so that's where it starts to turn. Where it crosses the zero line, the $0 line, that's your break-even prices. Okay, so basically at 184 and 57 cents, that's where you start to lose money. And then on the upside, you're at $215.43 is where you're going to start to lose money. And as you see it flatlines here and here, that means your risk is capped. Your risk is capped at 457. Now you can see right here in this little box right next to my cursor, it says profit loss $4.57. Add that to the 43 cents, and that equals your $5. Okay, so, but the big thing here is that you have a profit zone from $185 all the way up to $215. Google's at 201 right now. As long as it stays within that wide range, you will make the maximum of $43. So if you don't think Google can move that far, the $30 and the $15 in either direction, it's slated to only move $9 based on the implied volatility and the at the money straddle. If you think Google's not going to move that far, you can take this trade. Now we can throw that into the probability calculator, which we also have on our website. So I already pre-filled some of the numbers. Current price is 201.40. The expiration date is in 6 days. Let's say, you took that trade basically when there's 7 days left, because we can't trade on the weekend. Okay. And then we click on go. So basically, you have finishing between, here's the number, the box is down here. Finishing between the two targets, you have an 87.67% chance of Google staying within that range. So that's your opportunity or your probability to win. 87.67%. And if you wanted to go down to 6 days, that's the 90% right there. Okay, so you have 90%, but you can't take the trade on a Saturday, so we got to make it accurate. So there's your 87.67%. And finishing above 215 is an 8.5% chance, or finishing below 185 is a 3.76% chance. So you put in the first target here, second target here, and it gives you the probabilities. So if you're thinking an 87.67% probability is good enough for you, then maybe you consider selling some Iron Condors. Okay, that's how people make a lot of money. Now, if we look at something like, let's pull up Tesla here and see what kind of numbers we can get out of that. Now, you can certainly move closer to the at the money strikes. You'll get paid more money, but there's a chance that the stock could move, adversely against you. So let's look at Tesla here. Also August 15th, 6 days left. It closed at $330 roughly. And let's wait for these numbers to populate. So to find out how much it could potentially move, you look at the at the money straddle, which is the closest strikes to the current price of the stock. So we're going to use the 330s. So you got $7.85. Bring up the calculator again. $7.85 plus the 330 calls are worth $7.75. So we're looking at a $15.60 move higher and or lower. Now you can go down to the, it depends on how much money you're willing to accept or you want to take. If you go down to the 290 put, which is $40 away, you get 34 cents for you can sell the 290 put and you can buy the 285 put. Let's see what that thing's worth. So that wouldn't give you that much. You want to probably go a little bit more. Let's just say we went down to the 300 strike, 65 and 45. So that's about a 20-cent spread there. And if you go up to let's say the 345s, which is another 15, maybe we got to go higher than that because Tesla could really go. You can sell the 360 calls and buy the 365 calls. So that'll give you almost a 28 cent credit, 28 cent there, 20 cents for those. So that you're looking at a 48 cent credit, and you got a $452 potential loss. So you have to figure out, what are the chances of Tesla moving that far? We can also throw that into the probability calculator. We'll use the volatility at the money IV. We'll round it up to 43%, and we'll see what the probabilities are. Okay, so let's just put this in as 330 for Tesla. And it doesn't matter the strike. All you need to know are the numbers. Okay, 7 days ahead. And what did I say that volatility was? 43%. That's where you get the number to put in this box here. 43%. And we said our strikes were, was it the 300? Yep, the 300 and 295. So we're going to go 300 on this side, on the downside, 300. And we were looking at the 360 on the upside, I think, right? You can double check that 360. One more time. Just flipping back and forth here. The 360s were worth, and 360s were worth. Yep. All right. So the 360 on the upside. Click on go, and saying almost the same thing. 87.34% chance of winning as an Iron Condor seller. Now, if you were going to buy that Condor, that means you'd have an 87.34% chance of losing, because Tesla's not slated to move that far. So this is a way, people ask me, can you be on the other side of buying straddles and strangles? And absolutely yes. Selling Iron Condors is a hugely popular type of strategy. People use it on all different stocks, on the indexes. They do, 1 day options or zero. They sell the Iron Condor the same day, 0 DTE. You can choose any expiration you want. But so let's talk about what the returns could be on this case. Let's just say we sold that the Google spread for $43. Okay, and you only have to put up $457 because that's your maximum loss. So if we get the whole gain of $43 divided by $457, that's how you figure out your profit. Your return. You're looking at a 9.4% return in 7 days. If that Iron Condor finishes anywhere in between that range, you're going to make the $43, and all you had to do was put up $457. You're making a 9.4% return in just 7 days. Okay, if you can do that every single week on every Friday, and it expires the next Friday, every 7 days, let's figure out what that annualized return would be. And we're looking at times 9.4. You're looking at, and I hope these numbers are right, 490% return annually. If you were to do this type of trade every Friday for 1 week hold and make 9%, you're looking at a pretty good return annualized. Even the 1 week return of 9% is pretty good. Do that 4 weeks, you're looking at 37% return. So there you go. I wanted to show everybody what kind of opportunities exist in the options trading world. People come here to YouTube, they come to me, they're asking for help, they're looking for strategies, they want to know what they can do, how to make money. So I make these free videos trying to show everybody through my over 30 years of experience what kind of trades you can do. It doesn't all have to be based on picking a direction and buying an option and hope it gets there. Use the data, use the implied volatility numbers, use the IV crush to learn how to sell options properly and safely. You want to do these limited risk trades, okay? You don't want to expose yourself to unlimited risk. So there you go, how to sell Iron Condors. I hope this video has been helpful. If you found value in this, please give me a thumbs up. Please give me a like. Please subscribe to my channel. Leave me a comment. I'm trying to, tell everybody about the channel. Let's make my channel go viral if we can. Send me an email. I'll always answer your emails. What we do with the Smart Option Sellers, we sell options. That's what we do. If you want more information on anything, just click along the headers here and you can find out more about us, what we do. And you can send me an email as well. Down in the description, below the description, I've got links down there. Please take a look. Websites and books and other software that you can take a look at that may be helpful for you. All right, so that's it for me today. Hope it's been helpful. This is Lee Lowell. I'll see everyone in the next one.